What makes Murabaha Sharia-compliant? Have you ever wondered how Islamic finance operates without interest? One of the key concepts is Murabaha, a unique way of conducting transactions that aligns with Islamic principles. So, what makes Murabaha Sharia-compliant? Let's break it down. Murabaha is structured as a sale contract, not a loan. This distinction is vital because charging interest, known as Riba, is prohibited in Islamic finance. Instead of lending money and charging interest, the seller, often an Islamic bank, buys the goods first. Then they sell these goods to the buyer at a disclosed price that includes a profit margin. This profit margin is agreed upon upfront, ensuring both parties know what to expect. One essential element of Murabaha is actual ownership and possession. The bank must own the goods before selling them. This requirement guarantees that the transaction is a genuine sale, not just a loan disguised as one. Transparency is another critical factor. The seller must disclose the original cost of the goods and the profit margin added. This openness is in line with Islamic ethics and sets Murabaha apart from traditional lending practices. Importantly, there is no riba involved. The profit comes from selling goods, not from lending money. This structure avoids the interest issue entirely, making it compliant with Islamic laws. The price in a Murabaha contract is fixed and agreed upon in advance. Payment can be made right away or in installments. However, if payments are late, the total price does not increase. Any penalties for late payments are usually donated to charity, which prevents any unjust enrichment. Another aspect is that once the goods are sold, they belong to the buyer. The buyer cannot return them to the bank for more credit. This rule prevents the misuse of Murabaha as a revolving credit option, which would violate Sharia principles. Risk and liability also play a role. The bank takes on the risk of ownership while holding the goods before the sale. This responsibility is different from conventional loans, where lenders typically do not bear such risks. In practice, Murabaha is widely used in Islamic banking as a trade finance contract. It helps customers purchase goods, machinery, or raw materials without violating Islamic prohibitions on interest. While some scholars view it as a transitional from compared to profit hand-loss sharing contracts, it remains fully compliant when structured correctly. So, in summary, Murabaha is Sharia compliant because it is a genuine sale, involves transparency, avoids interest, and ensures that risks are appropriately managed. This makes it a popular choice in Islamic finance, allowing individuals and businesses to engage in trade while adhering to Islamic principles.